Multifamily real estate has been a favorite investment option. From the global financial crisis through 2022, three drivers were key: cheap debt, rising rents, and aggressive fundamentals. Together, these positive forces drove prices to record highs. But today, the market is shifting, and fast. Multifamily distress is making its way into the market. It's here, and it's reshaping the landscape for buyers, sellers, and operators alike. The big questions: how much distress will there be, and how will it impact multifamily investing in 2026? While the vast majority of multifamily owners and properties continue to perform well, there is a pool of assets that are facing increased risk. The distress is not systemic, it's generally isolated, but it's been growing. Delinquency rates in multifamily properties entering special servicing have risen to 10-year highs, and the distress is being driven by a combination of higher interest rates, maturing loans, multifamily oversupply in certain markets, and rising operating expenses. Numerous owners face challenges in refinancing loans or covering debt payments, particularly those with floating rate debt. Until recently, distressed assets hadn't surged like it had in previous cycles. Following the financial crisis in 2008, 17% of multifamily assets with CMBS debt faced distress. By comparison, at the end of 2025, distress level had increased to just over 6.9%. This cycle has been unique in many ways. Owners have been bailed out by lenders willing to delay foreclosures and by a large pool of preferred capital. Although certain borrowers have gained temporary relief through extensions, the data points to a substantial maturity wave approaching. Interest rates that are much higher than they were 5 years ago, and tighter bank lending standards continue to constrain refinance options. The result is a significant looming maturity wall. There are many loans coming due this year and are unlikely to be refinanced as the market has retreated from its high watermark in 2022. And in some cases, property values have retraced to or below the original purchase price. These challenges are being driven by aggressive value-add strategies, particularly in the Sun Belt, colliding with oversupply and weakening fundamentals. As these loans mature, we will experience a recalibration, creating an opportunity for well-capitalized investors. In general, distress will have a meaningful but not a huge impact on the market. It is important to recognize that it remains situational, not systemic. As we progress through 2026, investors will have a unique window to acquire undercapitalized assets with the potential for outsized returns. That said, conversations with investors across the country point to a consistent theme. These opportunities will have a heavy lift, often require significant capital investment, and a full operational reset. As the market flushes out these opportunities, we will see capital come off the sideline, potentially causing compressed returns for multifamily assets. Many investors and leading economists anticipate that distress levels will continue to rise in 2026 if interest rates remain high, with isolated distress opportunities potentially moving toward foreclosure or forced sales. However, some stabilization may occur in specific markets as the market adjusts to the new financial reality and fundamentals improve. Look for an overall rebound of the market in 2026.